Hi everyone, my name is Peter. I'm at Infinity House, which is an 18-bedroom student accommodation in Stoke-on-Trent. I'm on the first floor, where each floor there are 6 bedrooms with en-suites and a kitchen. On this particular floor, we've got the carpets in, we've got the radiators in, the lights are in as well, still needs to be spray painted, so we're definitely getting there. I thought I'll take the opportunity now to just answer some of the questions that a lot of people ask quite often. I meet with a lot of friends who are interested in property, and also meet up with a lot of potential investors. So I'll just take a few minutes just to explain the 2 different types of investors that we work with. So the 2 that we often call the 2 categories of investors that we use is an angel investor and a joint venture investor. So predominantly we work with an angel investor, and who they are actually just friends, people, anyone that we know that has money sitting in the bank and is keen to earn a higher interest rate than they would otherwise be earning. So currently in the UK, you might be earning maybe 0.5% per annum. With us, depending on the project, we've offered 6% per annum or more, and it depends on the terms of what the investor is looking for and also what opportunities are there. So it takes, usually from the time of meeting an investor, we often may not actually end up working with them for maybe 3, 6, 9, 12 months down the line, because during this time it's actually working and understanding how we work together and knowing what the other person's goals are. The second type is a joint venture. We do have a few partners. Now with joint ventures, the rewards can be bigger, but also the risk is still there as well. So what that means is we have investors who fund the whole project, where the rental income and the capital growth, if any, is split 50-50. Where we are in UK, we do all the work. The investor, who can be UK based or elsewhere, has an opportunity to work with us and invest in the UK by funding our deals, and we split everything 50-50. With these situations, we always take a lot of time to ensure that we get to know our investors. We want to be sure that they really understand the risks. So usually they are already investing in properties. Maybe they are investing in other parts of the world, or they've invested in UK already. So they really understand what the risks are. They understand how to do their due diligence and ask good questions, so that the partnership, so that everyone is on the same page in this partnership. So at a high level, that's what the 2 differences are. So the angel investor gets a simple return on their money, for example 6%, and with that 6%, once they get that money, they can do whatever they want with that. They can buy a holiday, go away once a year for free, instead of leaving the money in the bank where they wouldn't have earned anything anyway. And the second type is the joint venture, more sophisticated investors who are already investing in other parts of the world or in UK, and they're willing to share the profits and also share the risk. So if the property doesn't perform well in 5 years down the time because the market's changed and we have to go to a second strategy or second exit, they understand those risks. So hopefully that helps. Thank you for listening.